Should you invest in an ETF with 11.5% distribution yield? Now, notice we're not saying dividend. We're saying a distribution yield. So we don't know exactly what that consists of yet. I have a client who has this, a pretty big position in this fund, as a matter of fact. And we're going to dive into this. We're going to dive into it, all right? Because anytime I hear that large of a yield, I get nervous, simply because that means the price has gone down big time. The reason the yield is so high is the price has gone down. Doesn't mean it's bad, doesn't mean it's good. It just means the price is off, just dropped. So let's take a look at this. This is OXLC. If I can get this thing to, there we go. OXLC, in case any of you were wondering where the dogs were, there they are. They're fighting. Pop, Finny. This is the Oxford Lane Capital Corporation. All right, don't know the first thing about it. So we're going to look at this. All I know is it has right now an 11.49% distribution rate. So that, we'll see what they say is, this is on Schwab. Most recent per share annualized and divided by the previous day's closing price. It may include net investment income, capital gains, and or return of capital. That's my concern, always return to capital. All right, so right now the price is trading at what, say $7, something, yeah, $7.11. There's a lot of volume there. All right, so we're going to see, you can see it hasn't done much for 5 years. What was that, 2016? Is that about 12? And now it's down to about 7.5. All right. You got a distribution rate, but not an SEC yield. That's interesting. So maybe because it hasn't paid anything for the last 30 days. I don't know. But there you go, 7/30/2021. And there's a dividend right there, 6.5 cents. So we take 6.5 cents, 6.7. Can we go to distribute? Hold on just a second. We're going to go. Yeah, I don't think they do that on ETFs at Schwab. We can go back to distributions, performance. Let's take a look at performance here. I'm just showing. Look, I don't invest that many stocks, but I'm showing you what I do. Bank loan. Ooh, that's always my concern. Bank loan. Yikes. Cumulative growth of $10,000 investment. The blue is this guy. If you invested $10,000 back in 2011, it's worth $25,000 today. So it's good. Doubles money. That's reinvesting. You got to reinvest. If you bought the Barclays, okay, bank loan, okay, gotcha. If you bought the Barclays bond index, it's only worth $14,000. If you bought the bank loan, it's worth $17,000, and it got smoked last year like everything else did. All right, there you go. They're considering this a bank loan, and the bank loan is always what scares me, man, because 44%, and I tell you, the bank loan stuff scares me to death, because I remember what happened in 2007 and 8 and 9. Bank loans got smoked. So this is going to be basically what a bank loan was. A lot of car dealers and things like that. A lot of underwhelming credit rating, if that makes sense. So a car dealership would have a floor plan. It'd basically be underwritten by a bank. It's very risky, but because their turnover is so much that it's short-term financing, because they're trying to move the product, trying to get the product, move the product, get the product, and stuff like that. So in of itself, bank loans aren't bad or good. They just are. But because there's a short-term endeavor, as long as they can sell their inventory, they're fine, if that makes sense. But given that it is a risky proposition because it's based on a vehicle as the underlying security on that, and the vehicle, of course, doesn't retain its value, the bank loan is a risky proposition. Now, again, that doesn't mean it's bad. In 2007 and 8, the reason bank loans got smoked is because there's no buyers out there. The mark-to-market accounting smoked it. But again, this happened in 2022. That's kind of concerning to me, just because it happened in 2008 with getting down about 45%, bank loans did. And it happened that you could have attributed that to mark-to-market accounting. But if it happened twice in 12 years' time, 45% declines, that's worrisome to me, especially if it's a more secure product that you like to think, short-term debt. Anyway, so let's take a look here. So how did this guy do? When did that get smoked? Anyway, that's bank loans, and I'm not sure that's what happened to this guy or not, but we'll see. All right, so what else are we going to look at? It doesn't give us a distribution. I wish it did, man. Let's see, portfolio. Let's see. Oh, maybe it does. Charts. Maybe that'll tell us the dividends here. But it's 6.75. Here we go. All right, cool. Does it tell us the dividends on here? Hold on just a second. Events. And we want that. Dividends. There we go. Sweet. 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 14 cents. 14. Oh, so look at this. So here is paying 55 cents. 55 cents, yeah. 55, 55, 50, 60, 60, 14, 40, 14, 14, 14, 14. Why did it drop the dividend so much? Now it's paying 7? You know what's happening here, don't you? Ooh, look at that. So this guy was paying 24 cents, 48, 50, 55. Now I only paid twice back then. So I only paid $1.10 back then on $16 share price. $1.10 on 16 bucks. You got 3 there. All right, so you got how many here? 2, 4. Well, I got 4, but they're only, is it a special dividend? Oh, Q2 and Q3. Q 2012 and 2013. All right, 2013. Okay, there you go. So Q1 paid 55 cents in Q2 2013. All right, there it goes. No, that's odd. Anyway, so they paid, back then they paid 55 times 4. That's $2.20 on a $17 price. That paid back then $2.20 divided by 17. That's a 13% distribution yield. 60 cents paid, yeah, paid 60 cents 4 times, so quarterly. There you go. But then why did it drop so much? Look at that. And the price dropped too. So they obviously said we're going to lower our. So obviously they made ideas that they're going to lower their dividend. And when they did, the price dropped. But they didn't lower it then. They didn't lower it then. They lowered it then. They lowered it there. And then they lowered it there. So, but let's check this out. Obviously, they're making in 2015. They're making some headwinds. They're going to lower their dividend. But, well, the company probably was saying, but it didn't happen until 2018. And look at that, 14 cents, man. Eesh. And then I'm sure they're making headwinds. They're going to lower it again, and they did. 7 cents. That's concerning to me right there. So they've lowered their dividend by, I mean, look, man. Oh, yeah. All right, so let's go back to Schwab. They have this thing called CEF report card. I don't know the first thing about this company, just my man has it. And they're in a decent position as too. All right, so can we get rid of this guy? There we go. Let's make this bigger. All right, let's make this bigger. All right, let's see if we can't make this blink. 1 sec. All right. Yeah, worst 3 months, 57%. Yeah, I'm not telling you, man. I won't touch this 10-foot pole. Now, this guy's already into it, but it's come back from 410 to 7. Where's it at? 711 right now. Yeah, bank loans. Ugh. Gross expense ratio, 12%. Damn, 12%. Oh, yeah. Yeesh. I don't know, man. Yeesh. Schwab closed-end report card. Not getting very high ratings from Morningstar. High expenses. Ah, man. People get, oosh. Look at that, 54%. I mean, you can't have 57%. Ugh. Annualized returns 8.6. Yeah, well, it's aggressive. No way around that. But hey, all right. So I want to show you something else here too. Yeah, that doesn't do it for me. That's for sure. So bank loans. So just compare it to the bonds, and then we're gonna come back and look at portfolio visualizer and compare it to stocks, because this is risky as a stock. Does it give us standard deviations on this? Portfolio turnover, distinct portfolio, domestic stock. They got a little bit of stock, a little bit of bonds. So they're leveraged too. Look at that. Yeah, 56% short. Oh, that's how they're doing it on leverage. Oh, So much risk in this thing. Fanny, hold on. Does it give us a standard deviation? I'm sure we can figure it out. I just don't feel like crunching the numbers here. Yeah, it's had that nice run, but other than this nice run, it was at par from where it was 10 years ago. Then again, stop. Mid-Ocean Credit, Regatta, Octagon Investment Partners, Aries. All right, so let's keep looking here. So we'll see if we can't pause real quick. Right, so you're going to get 66.7 cents, 6.75 times 4. You're going to get $2.70 a share as a dividend. I'm not sure what kind of dividend. Are those taxes or qualified dividends? I don't know how those are taxed, actually. I don't know. Leverage 37.4%. Annual net expense ratio 12.1. Damn. That's nuts. The market price is up 110% since a year ago. All right, so let's look at Portfolio Visualizer. I got it up here someplace. Where do I got it? I got too many windows open. So I looked at Portfolio Visualizer. I started this. We're going to have reinvest dividends, yes. And we're going to go from start to finish, essentially, whenever this guy was incepted, 2012. And it's up to $28,000 if he would have reinvested dividends. So let's compare it to the S&P, just for simplicity, the VTI. We'll benchmark it to just do the S&P 500. Finnegan. Oh, boy. And we'll see. Yeah, all right, hold on a sec. Bang! All right, so you can see S&P 500 smoked it. It's up. Hold on a sec. All right, so look at this. The S&P smoked it. Obviously, the reason the S&P smoked it from this last year, but they both went up. It's just this guy got killed right there. Look at that, man. This guy was down quite a bit. Went from 19,000 to 10,000. So, I lost 50% of his value. Went from 26 to 11, lost 65% of his value, something like that. The S&P looks flat compared to this guy. All right, so I want to show you that's what if we reinvested dividend. What if we took the dividends out? Yeah, I just don't like it, man. I'm sorry. I wouldn't touch this 10-foot pole. If we took the dividends out, this is where, look, because this is growing dividends. This is why I stress about these high yielding things. You want growing dividends. This is not growing. This is reducing the dividends. This is taking the income off. S&P 500 taking the income off is worth, I got to move my thing out of the way, is worth $35,000 after taking the income off. You start with $10,000 in 2012, it's worth $35,000 now. The other one, you took the income off, is only worth $5,000. I don't think it tells us how much income it give us, did it? Does it? I'm not sure. Let's see. I don't think it does. Does it tell you income or drawdowns, rolling returns? Yeah, I'm not sure. I have a premium link here, but anyway, I don't know. Let's go to drawdown. Oof, look at that. That's nerve-wracking to me. Metrics, exposures. Oh, yeah, here we go. Let's go standard deviation, volatility. Oh, yeah, it's like 3 times as aggressive, as volatile as the S&P 500. Yeah, I just don't like it. I don't like that stuff, man. I don't like that stuff. The leverage kills you. Anyway, I wouldn't touch it, and I'll email my friend, my guy, and say, look at my video. Woo! All right, I'd like to hear your thoughts. We'll see you guys.